If you really want to build wealth and never want to stress about money again, there are 5 different types of assets that you want to buy. The problem is, if you ask the majority of people, they'll tell you to buy a random stock or cryptocurrency and hope that you get rich. And that's why most people end up losing money when they invest, despite the fact that the stock market has grown by more than 10% a year on average for the last century. But that ends today, because in this video, I want to talk about how you can actually build wealth by investing in 5 different types of assets, which are paper assets, hard assets, protectionary assets, speculative assets, and income producing assets. And the reason why we're talking about this type of real diversification is because sometimes markets crash. If the stock market were to crash, well, you're still protected because you have other types of assets. So let's break this down one by one, starting with paper assets. A paper asset is like a stock. On paper, it says you have ownership in a company. When the average person says, my investments are diversified, they generally mean something like, I have stocks in blue chip companies, I have some emerging market stocks, and maybe I own some AI stocks. So I'm diversified. But the problem with that is all of our investments are in paper assets. All of our money is in the stock market, and we've seen the stock market go up and the stock market go down. And even though you own different types of stocks, when you see a stock market crash, many times the broad stock market gets hurt. And this is where you want to understand that that's just one type of asset class. The stock market is just one type of asset class, but it is an important asset class. And here's the mistake that so many people make. They say, I want to come in and buy here and sell here. This is a rough depiction of the stock market where we know markets go up and markets go down. So we want to buy here and sell here, but that's not what actually happens. Instead, what many people end up doing is they end up buying at the top and then they end up selling down here because they panic and they sell. And the reason why is because there's a lot of emotion around the stock market, and because it's paper, it's very easy to buy and sell. You can buy and sell your stocks on your phone or your computer, and here's what ends up happening with the emotion. When markets are going up, people get excited. People talk about how much money they're making. And then you have the media come in and they talk about how people are getting rich buying stocks. Uber drivers are making more money from the stock market than they are actually working as an Uber driver. And then you start to get more people excited, and then you start to hear the Reddit communities and other social media communities talk about if you just buy these stocks, you're going to be able to get rich. Then what do you think happens? A lot of people who have never invested their money before or who are newer investors get excited, and then they start to come in and buy at this area right here. Then you start to see this little bit of a dip, and people start to get scared because now markets start to go down. Oh no, did I buy at the peak? Am I going to lose money? Because now you're investing your hard-earned money and you never want to see it in the red. You never want to see it go down. And then the media comes in and they say, oh no, was this the peak? Is the market going to crash? Are we on the way down? Are we going to see a recession? Are we going to see a market crash? And what happens? Because it's paper, because it's liquid, it's very easy for people to come in and sell. And then as people start to sell, markets start to go down, people panic, and then they sell at a loss. So instead of buying low and selling high, people actually end up buying high and selling low. And this is where, if you're just getting started as an investor, one of the simplest things that you can do is follow a strategy like A, B, B. Always be buying. You buy here, 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 here. You're buying when the markets are going up and down. You can create a simple system where you're buying every week, every 2 weeks, every month, and now you don't touch it. You don't touch it if you're in a recession. You don't touch it if you're in a market boom, and you let the markets do their thing. In fact, do you know how many recessions we have seen over the last century? 16. And so when you have these recessions, markets go down. And when markets go down, most people panic, but they also create great buying opportunities for those that are financially savvy and understand that if you just ABB, always be buying, have an automatic system, just keep buying. You buy every week, every 2 weeks, every month. Well, now you don't got to worry about it, and that has been a proven way to win. But then the next question is, what do you actually buy as a paper asset? Which stocks do you buy? Should you buy Tesla? Should you buy Amazon? Should you buy Apple? What should you buy? And here's the reality. If I tell you which stocks you should buy, chances are you might lose because you don't know when to sell, you don't know when to buy. But if you just want to win, not to mention that you might have a different goal than me because I like investing for cash flow, meaning dividends. And this is where one of the simplest ways that you can start is not try to find the next Tesla, not try to find the next Amazon, but instead just invest in the economy. Let me show you. Now this is where I got to give you a disclaimer because I'm not a financial advisor. I'm just a random guy on YouTube, and investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. But let's talk about a few ETFs, meaning funds that you can invest in to give you exposure to the broad economy. One example, VTI. This is an ETF that gives you exposure to the total stock market. This is created by an institution called Vanguard. If you buy one share of this on your stock brokerage, you're essentially buying the total stock market, a piece of all the companies that make up our stock market in the United States economy. ETF example number 2, SPY. This is an ETF that gives you exposure to the S&P 500. This is a group of the 500 largest companies in the stock market. So if one of these companies starts to not do good, they start to maybe go on the verge of bankruptcy, well, they get kicked out of the S&P 500 and they get kicked out of the fund and replaced with another company. This is an ETF that gives you exposure to that S&P 500. DIA is an ETF that gives you exposure to the Dow Jones. The Dow Jones is one of the oldest indexes out there, meaning groups of stocks out there, which is kind of like a little sample of the United States economy. Example 4, QQQ. This gives you exposure to the NASDAQ. The NASDAQ is a group of the 100 largest non-financial companies. So many of these are actually tech companies. So if you're investing in QQQ, you're investing in those 100 large non-financial companies, many of which are tech. And just for fun, I'm throwing in one more, VYM. I am personally invested in this one. This is an ETF that gives you exposure to dividend-paying companies, more specifically, high-yield dividend-paying companies. Again, this is created by Vanguard, so if you like cash flow, this is one that you can consider. But there are many other types of ETFs. This is just a way to get you started on your research. You can start to see how we're thinking differently than the majority of people, because when most people think about investing, all they think about is the stock market, but that's just the beginning. And this is where you want to invest in multiple different types of asset classes so you can have real diversification, because if the stock market were to crash, well, now you have different types of assets to protect you as well. Now, if you want to be a smarter investor, this is why my team at Briefs Media publishes a free newsletter called Market Briefs. It's published 6 times a week, and it breaks down what's happening in the financial markets. We cover things like the stock market and the real estate market and the crypto market and the global economy and our own economy into a fun and witty and easy to read newsletter. That way you can be a smarter investor. It's a completely free newsletter. We have hundreds of thousands of investors that are reading and loving Market Briefs every morning, and it's completely free. So if you haven't joined Market Briefs and you'd like to join, I got the link for you down in the description below. Now let's talk about hard assets. An example of a hard asset would be investing in something like real estate, because when you invest in real estate, you can see, feel, and touch the bricks. You can see, feel, and touch the property. When you invest in a stock of Amazon, you don't actually own any physical thing. You buy a piece of paper that says you own some of the Amazon company, but if you walked into the Amazon factory, they wouldn't know who you are. When you invest in a rental property, well, now you are the one that's in control. It is a hard asset, and you see, feel, and touch the land that you own. Now notice that I said real estate investment rental property. When I talk about investing in a hard asset, I'm not talking about you buying the home that you live in. That home that you live in, I consider a liability. I consider an expense, not an investment. I know this goes against most traditional financial advice that you get, but for me, the house that I live in is an expense. It's not putting money in my pocket. Sure, maybe it goes up in value, but then I have to actually sell the house to realize that money, or I have to take on more debt. But that's not actual money, that's debt. So when we talk about real estate investments for the purpose of this video, I'm talking about going out and buying a rental property, because when you have a rental property, here's how it works. Maybe you go out and you find this house for sale for, we'll call it $200,000. Now the goal is you're not going to buy this house to live in yourself. You want to rent this house to somebody else. So you find a nice family who wants to live in this house, and because you built this amazing house for them, they are excited to live in this property, and maybe if you do it properly, they will pay you, let's call it $2,100 a month to live in your property. This is the money that's going to you as the landlord, as the investor for owning this property. Now, the first thing you're going to say, I already know, is, Jaspreet, where in the world are you going to find a property for $200,000 that you can rent out for $2,100 a month? Well, if you're living in Miami, if you're living in California, if you're living in New York, yeah, it's not going to be possible. But there are many states and many cities around the country where you can find these types of deals. In fact, my office is in downtown Detroit. In Southeast Michigan, which is a beautiful area, by the way, you can find these types of deals all day and night long. So You find a property for $200,000 that you're now going to rent out for $2,100 a month. It's a nice property. This family is happy that they get to live in your property because you're giving them the value of a home. They pay you rent, and now you got to pay for the expenses. What are these expenses? Well, you got to pay property taxes. You got to pay for the property insurance. You got to pay for the maintenance because when the toilet breaks, you got to pay for it now. Then you got to pay for the management because I don't want you to be the one that's getting the phone calls when the toilet breaks. I don't want you to be the one that gets the calls when something's wrong with the plumbing. I want your property manager to deal with all the headache. I want you to be the investor and just make sure that you're getting paid. And then you got to pay for any vacancy costs as well, because sometimes these people are going to move out and they're going to find a different house to live in for themselves, and you're not going to be getting rent. And so you want to make sure you have the cash to cover that time as well. So now let's run through some numbers. $2,100 a month in rent times 12 months a year is $25,200 a year in gross income. Now you got to subtract your expenses. That's property taxes, insurance, maintenance, management fees, and your vacancy costs. So let's assume that that costs you around $11,000 a year to maintain this property. And I'm going to assume for the purposes of this video that you brought this property cash without a debt, because we're going to just keep this very simple for the purpose of this example. That means your profit at the end of the year after paying for all of your expenses is about $14,200 a year. But now let's do a little bit more math to see if this is actually a good investment or a bad investment for you. You're making $14,200 a year. You put in $200,000. So if you take $14,200 and you divide this by $200,000, what this tells you is you're making about 7.1% a year in cash in return on your investment. You put in $200,000 of your own cash, you're making $14,200 a year, which means you're getting a 7.1% cash on cash return on your money. Is that good? Is that bad? This is going to depend on you, where you're investing, and what types of returns you're looking for. For me, this is a good return. I'm looking for a minimum of a 7% cash on cash return on my money. I want to invest my money in an area which I believe is growing, where I believe rental values are going to rise. I don't really care about property appreciation. I don't like trying to guess that maybe this property is going to be worth $300,000 in 3 years. That's not the game that I'm playing. When I invest in real estate, this is what I'm looking for. This is what I'm looking for. I want to see how much money do I have to invest today and how much cash flow am I going to get each year for my investment. That's the game that I'm playing as a real estate investor. Now you got to decide what's right for you, because if you're investing in New York or Miami or Los Angeles, you're not going to see the same 7 or 8% returns. Generally, in today's market, it's going to be a whole lot lower. And you got to find what's right for you and what types of investments you're going to be looking for. But this is a hard investment because now you own the property, you own the bricks, you own the land, you own the windows. It's something you can see, feel, and touch, and it's something you can operate as well. Now you might say, well, Jaspreet, I don't got $200,000. I'm not saying you have to start with $200,000. There's many different ways that you can get started. If you don't want to go out and buy this whole property yourself, obviously you can use debt. Obviously you can go out and raise money from other investors. Maybe you have rich family members. Maybe you have some rich friends. You can raise money from them if they don't have the time, but they have the money, and you got the time, but no money. Now you are a good match for each other. Or you can look for other deals to invest your cash into as well. If you go to any real estate investor conference in your area, they happen all throughout the country. You can look for people that are looking for money. And there's always people looking for money. There's always developers. There's always investors. There are always people that are looking for funds to go out and build or manage the next deal. Well, you can give them some money and then you get some ownership in the project. Or you can look for other crowdfunded deals in your area. For example, you can look in my description. There are companies that I've partnered with that you can invest your money into these crowdfunded deals. You don't have to worry about managing the property or doing any of the work. You're just getting some exposure to that real estate. So now you just got to figure out what's the game that you want to play. Do you want to just invest your money to get exposure to the real estate, or do you want to actually own the real estate yourself? Now, there's different tax advantages if you own the real estate yourself, but that's going to go beyond the scope of this video, and I will make a different video about that, or you can watch some of my other real estate investing videos as well. Now that we went over paper assets like stocks and hard assets like real estate, let's talk about protectionary assets. An example of this would be investing in something like physical gold, because when you're investing in gold, you're not hoping that this gold goes out and creates more value like you would a stock. Because when you invest in Amazon, you're hoping Amazon's going to create a whole new product, make bigger profits, and grow their valuation because it's a more valuable company. When you invest in gold, that gold just sits there and looks back at you. It doesn't really do anything. Now, sure, there are some practical uses for gold in the world, but that gold that you have sitting in a vault, if you're investing in gold, or sitting in your drawer, or sitting in your basement, it's not doing anything. It's just sitting there. there. And so the goal for the gold is that it is a protectionary asset against a worst case scenario situation. The way that I do it, again, I'm not telling you what to invest in, I'm not telling you what to do, I'm just telling you what I do. When I invest in physical gold, I buy a little bit of gold every single month. It makes up a small piece of my total portfolio, about 2% of my total portfolio. But when I invest in gold, I don't consider it an investment per se. I look at it as a way of saving hard money, kind of like hard dollars, hard money, because my theory is if I were to take $10,000 worth of cash today and $10,000 worth of physical gold today, and I buried both of those two things in my backyard today, and then 10 years from now, I go to dig up the cash and I go to dig up the gold, my theory is that the gold would have more buying power than the cash. So I look at it as a way to save hard money, and we know that gold has been a currency since the beginning of time, essentially, and so it has been a universal money around the world, and so for me, it is like that type of insurance, a doomsday insurance and a way to save hard money. It's not something that I really monitor the price of. I don't really care what's going on with the prices of gold. I know gold became very popular post-pandemic, after the worries of inflation, after the worries of people concerned about the dollar. It started to become a lot more popular. For me, it didn't really change anything for me. It was just continue buying a little bit of gold. It's not a lot, buy a little bit of it, and just keep letting it do its thing. And it's just a way to save some hard money as protection. That's why I call it a protectionary asset more than anything else. It's not a big piece of my portfolio. It's a very small, tiny piece of my portfolio, just in case, worst case scenario. And for all of you financial nerds, you might find this interesting, but my family is from a state in India called Punjab. And in the Indian culture, it is very normal that when you get cash, or there is rupees, when you get this cash, you convert this cash to something like gold because there's really high inflation over there. And so it's just normal culture that when you have a lot of cash, you don't want to keep the cash because you know this cash is going to lose its buying power. So many people just naturally convert it to gold. It's not really considered financial education. It's just normal because that's the culture over there. But this is where understanding kind of different parts of the world, how to look at different types of assets, you might find that interesting. Which brings me to number 4, speculative assets. A few examples of this would be investing your money into startups or cryptocurrencies or trading cards or NFTs or art or watches. What does this mean? These are things that can go up in value very quickly, but they can also crash in value very fast. And the reality is you got to understand that, hey, this is speculative. And this is going to play a specific piece in your portfolio unless you are very specialized in this, unless you're a very specialized startup investor, unless you're very specialized in the crypto game, unless you're very specialized as a person in the trading card business. You got to understand the game because many people will end up losing money in these places because they don't understand how the game works and they think that this is a place to dump their life savings, their life investments, when in reality it's a very speculative investment. Speculative means maybe it can go up very fast, but it can also crash just as fast. And it can be very exciting and it can be very fun, especially if you can use this watch, if you can use this Rolex in your day-to-day life. Hey, you're buying a $15,000 Rolex, but it's really an investment because you can be able to sell that $15,000 Rolex for 20 grand in just a couple of years. But maybe you won't. And this is the game that you got to understand. Don't go into these speculative investments thinking it's a guaranteed win. You got to understand the risk, higher potential return, which means it can also fall just as fast. I have invested in multiple startups, and many startups that I've invested in have failed, went bankrupt, or some companies that I never even heard from again. It is risky. The goal is you make a huge return, but sometimes you're never going to hear from them again. I have made a lot of money in cryptocurrency. I've been investing in cryptocurrency since before it was popular. I started investing in crypto back when Bitcoin was around $3,000, $3,500 a coin. Well, I have seen the rise, but I also know that Bitcoin falls, cryptocurrency falls just as fast. Yes, there's value in Bitcoin. Yes, there's value in blockchain. I understand that. That's why I have invested in it over the years. But I also understand there's a lot of risk involved as well. And sometimes people get caught up in the euphoria and the excitement, thinking nothing bad can ever go wrong. And guess who was the first to lose their money along with everything else? You got to understand when there's a lot of easy money floating around, a lot of these speculative assets can boom. But when you start to see money tighten up, when you start to see the economy slow down, which investments do you think people are going to sell out of the fastest? Is it the one that's putting a roof over their head? Or is it something that is just sitting there that is losing value very quickly? And so you got to understand how this is going to play a part in your portfolio. For me, my speculative investments are about 16 to 18% of my total investment portfolio. So it's not a huge piece of my portfolio, and I didn't start putting much money into my speculative investments until I had established the hard assets and my paper assets, my real estate and my stocks. Those were the things I put most of my emphasis in, and as I started to build more wealth there, then I started investing a little bit of money into speculative assets. But you got to understand how it plays a part in your portfolio. If you're just getting started, maybe maybe 10% of your portfolio in speculative assets, maybe 12%. But as you start to build more wealth, then you can consider putting more money into these, but just understand the risk. Now that we've covered speculative assets, let's talk about income producing assets. These are investments that put actual money in your pocket to fund your lifestyle. Here's a few examples of what I mean. If you put cash in a high yield savings account, maybe you're going to generate, let's call it somewhere between 3 to 4% a year on your money. So if you can invest $100,000, which is a lot of money, you're going to make 3 to 4% on that. $3,000 to $4,000 over a year in interest. Not anything significant based off of the amount of money that you have, but it is better than nothing. If you take that money and you put it into the stock market, well, there are some companies in the stock market that pay out dividends. And if you bought $100,000 worth of stocks today, maybe you're going to generate, let's call it 2 to 7% a year in dividends. Are there some companies that pay out higher dividends? Absolutely. Are there companies that pay out lower dividends? You got it. But somewhere between 2 to 7%, which means if you put in $100,000, $2,000 to $7,000, which is again, not a lot of interest based off of that amount of money that you invest. Now, does that mean that you shouldn't invest for dividends? No, I love investing for dividends. The way that you actually win in dividends is by investing consistently for the long term, because as you keep investing more money, so the money that you're getting in dividends each year will hopefully keep growing as you keep investing more money to buy more dividend cash flow as well, because as companies grow their profits, they will hopefully pay out bigger dividends as well. So the game here is for the long term. But let's keep going just for the purposes of the example. If you're investing in real estate, let's call it 5 to 8%. Again, is it something that's gonna change your life today? Well, not necessarily, but as you stack more real estate, it can be very powerful. When we talk about income, I want you to understand the reason what I'm trying to get at today. The point that I'm trying to get at today is having a business, having a cash producing business is really where now you can supplement your lifestyle and supplement how much money you're investing, because these are places that can make you rich when you're already rich. Or these are places that you can take your money to produce some additional side income. This is where you can put your time to generate more interest, because there's an infinite level of return that you can generate from your business, because there's no real limit. I mean, you can start a business for $500 and maybe it grows to a $10,000 a year in income, or $100,000 a year in income, or $1 million a year in income. There's really no limit there. I mean, I talked about today, I run a company called Briefs Media that was funded through Minority Mindset. And I started Minority Mindset with an investment of less than $500. I know it was a lot less than $500, but I like to save $500 just so I have a big enough cushion to cover everything. But I started Minority Mindset with a $25 or $35 tripod, a $25, $35 light, and that was it. And then slowly we started to grow, we started to make some money, to use that money to start Briefs Media. We started to hire employees, we started to get better softwares and better things that we're doing. But it all started with a smaller investment, which then created a new income producing asset, a new income producing business, where now I can use that money from the business to go on vacations, or I can use that money to invest into other assets and invest back into my business. But the point that I'm trying to get to is the way that you build wealth is by owning these investments, owning real estate, owning stocks, owning some speculative assets, owning some protectionary assets. But you got to have money to invest into those things. And maybe you have a job right now, which is great, but you can also look for additional ways to create new incomes that we have our money to keep investing. I am not saying these things are bad. In fact, I love investing for cash flow. The majority of my passive investments, and meaning everything outside of my business, is cash flow producing. That's rental properties that are paying cash flow. It's stocks that are paying with dividends. But you got to understand, you have to have the money to go out and buy those things. And that's where having something like this, or being very strategic with your income from your job, can be very good. Now, if you're not making enough money from your job, that's where you can consider getting a second job or starting a side hustle. But just understanding the game that you have to have an income that you can dump into the investments. That way you can produce more income, that way you can produce more wealth, because wealth is ultimately when your money is going out, producing that wealth by working even when you're not working. Let me show you what to do with your next paycheck. That way you actually have a system to build wealth step by step. Let's assume that you make $60,000 a year. That's $5,000 a month. The problem with this $5,000 a month is you don't get to keep all that money because you got to pay taxes.